Hello and welcome, everyone. It's great to have you again on the show. I'm Ben Martinek, your host with the Catholic Money Mastermind podcast. We've got another member of the Catholic Financial Planners Network with us. His name is Jonathan Reich, joining us out of Waukesha, Wisconsin. Is that right, Jonathan?
That's correct. Yes.
Jonathan. Yeah, Jonathan is a recent member, a recent addition to the network. We want to give some airtime and talk a little bit about his firm and his background, but also we have an interesting topic matter of tactical asset allocation, which is not something we've really delved into. It's a different angle on how to manage a client's portfolio. So we're wanting to touch upon what maybe a tactical asset allocation approach would entail. So should be fun. Looking forward to it. Us busting our chops a little bit on this conversation piece. But Jonathan, before we get too far underway, I believe you're working with Global View Capital Management in Waukesha, Wisconsin. Could you just share a little bit more about where you find yourself at in the firm that you're part of?
Yeah, absolutely. So I came on with Global View Capital Management May of 2024, working directly with the CEO who has her own book of business, her clients, servicing about 127 households while I am building my own book of business as well. So most of my day is spent on client experience, client service, and really the ins and outs of paperwork. And then when I have time, doing the advisor job too.
Gotcha. Well, and prior to coming to Global View Capital Management, you had spent some time, I think, with both Equitable and Fidelity, and more specifically their retirement team, and dealing with a lot of client service calls. It sounds like, you got a lot of experience just connecting and chatting with people, in their call center. But then there was maybe an issue of just not really getting to know people very much, or it's different question, different day. How was that experience? We haven't had anyone on who's talked about their prior experience with a larger broker firm. What are some of your thoughts on both Fidelity and Equitable?
I think Fidelity is great. They pride themselves on their client service. I'd take maybe 20 to 30 phone calls a day. Could be anything from a password reset to cost basis questions, trades for stocks, bonds, mutual funds, foreign exchange wires. Not the funnest, but those take about 20 minutes. But yeah, it's just a different client on every phone call. And I wasn't getting to build relationships like I really wanted to be doing. Got a lot of great experience, a lot of product knowledge, how things worked in this industry, but really couldn't apply that to the same client over and over again.
Sure. I can see that being difficult. In my own experience, I've always been working in an engagement where the clients that I'm working with are, I suppose they would be my clients, and we meet and we discuss things, and you get to know them, and it's not just about their financial goals, but about hitting, their future family goals. And so it's, there's a connection, a bond that you establish with that individual. I wouldn't imagine it would be difficult, because in a lot of ways I'm answering the same technical questions that, maybe, I would be having in a call center, but then you lose out on that whole relationship bond, and, all you're doing is just answering the same technical questions day after day. I imagine that at some point this just starts to be like, man, you start to wonder, you can't see like the real fruit of your labor and maybe the difference you're making in someone's life. Is that right?
Yes, absolutely. I'd say not seeing the fruit of my labor, and then clients know they're calling into a call center. They're going to talk to a random person. There's just no prior relationship there. So, you get your mostly good calls, but then every once in a while kind of chewed out by someone.
Sure.
It's
well, if Fidelity is like any other large corporate entity that I've chatted to, sometimes just finally getting to someone is just a feat.
Yes.
You just can't get in, and you're just like, oh, finally, I got to somebody, but then I'm not always in the best of spirits when I'm chatting with that person. So, no, well, I'm trying to bring this up because part of the difference of having a financial advisor and having a dedicated person, and like someone you could get with the Financial Planners Network, is that it's a different client. It's a different experience for both parties. In that arrangement versus maybe working with a larger brokerage entity or firm where they do have a call center. And yes, you can get your questions answered and you can get the help you need, but for both people, involved, both the advisor and for, the caller, the prospect, or the client. The relationship is very transactional, to say the least. It's on to the next person, and you just don't ever know if anything came from the conversation you had from them. I suppose, was it ever the case that you heard back from the same person? Did you ever have like your regulars always calling in?
No, I mean, they have so many clients. It was every once in a long while, it would be like everyone would be amazed that someone got connected with the same person twice.
Is that right? Yeah. Just a different person every time, right? Yeah. No, I can imagine what that would be like, right?
Yeah,
for sure. So you migrated over to Global View Capital Management, and one of the things that has stood out in your mind is just the ability to develop these relationships and get to know the clients and to make more meaningful differences in their lives and to really function in this trusted advisor relationship. But also, I mean, what's interesting, Jonathan, is we were getting to know each other ahead of the call. Is just that your firm, as a topic, has a focus in tactical asset allocation. Mm-hmm. And I'd like to just share a few words and then kick it back over to you. For anyone who's listening, to the show, you may not have heard of what tactical asset allocation or management is. And, it is a bit of a technical term, and where it would stand or pair itself is, against what would be maybe strategic asset allocation versus tactical, and what does strategic mean? And so, there's different ways. Only maybe just to back that conversation up even more, there's different ways in which to manage or invest money. The question here is, we're all seeking and hoping to get returns on the money that we're making, but portfolio finance theory would be, let's get the very best returns that we can, but not just the very best or the highest returns, but the returns that are also, if in a way like whiskey, almost like distilling the return out. We want, the least, for every bit of risk we take, we want to get as much return as possible for that risk. And part of what we mean in our space by risk is, because we have to define it in some way, we mean volatility. We mean the ups and downs. It means your account balance might be doing really well one day and then not doing so well the next day. And specific to the investor, right? If your account, let's say at one point was $100,000, but now it's down to $80,000, it's possible that you might still get the same return side by side between two accounts. But if we could, just as a matter of improvement, have that second account get the same return but not have the volatility to it, well, why not maybe shoot and try to take for that? So just to kick it over to you to then, Jonathan, it sounds like, your firm's approach with a risk-weighted adjusted return is really geared towards like, how can we get the most return in a client's portfolio while making at the same time the smoothest ride for them as well. Do I have the right take on that, or what are your thoughts?
You do. I'd say that's pretty close to how I would explain it to a client. We're definitely looking at risk-adjusted return rather than just total return. We're looking at what we would call like kind of downside protection, setting stop losses based on market data to protect against large downturns in the market, such as the '08 recession, COVID, tech bubble burst. Those big events, if you lose 50% of your portfolio value, you got to have 100% return to gain that, to get back to where you started. So if we can smooth out that ride with collecting market data and applying that to our trading, that's what we do for the clients. And we streamline that by sleeving out strategies. We trade across everyone's account in block trades, and we also have low account minimums as far as, I'd say for the strategies, we offer low account minimums to get into the strategies. So I'd say it's a pretty ethical system regarding removing the priority trading for wealthy clients, really providing strategies that have longevity, have performed well, and working with these third-party companies to collect market data. I think it's a very ethical system that they've created, and that really justifies a advisory fee at the end of the day. I feel like our clients have historically at least gotten what they have paid for.
I've got it. And part of what they're getting in exchange for this, again, is because, I mean, they get different ways to build and establish and create a portfolio. And, usually we're spending, sharing, spreading money across different asset classes. And then each of those asset classes has kind of an expected return that we're wanting to deliver. But you could take, what would often be described as just a buy and hold arrangement, where it's like you hold the asset class, and then if that asset class goes up, you go up with it. If it goes down, you go down with it. Like, we're not trying to cut the tops off or take the bottoms off. It's just you go with the roller coaster of the ride of those asset classes. But the truth is that as much as the defining aspect of like a strategic asset allocation arrangement is you just kind of decide how much to hold of the different asset classes you have. And you could have as few as just a couple asset classes, but you can maybe have as many as 10 to 15 possible asset classes, right, in a typical portfolio. And then, a strategic approach is like, well, we're just going to have a committed amount of percentage points to these different classes. And then, if things start to get too far out of whack, we'll adjust back to maybe what the model would suggest. But the thing that approach doesn't really fully capture, that a tactical asset approach would and could ultimately be really beneficial and desirable, is that in specific to each asset class, you have still like a market price, a stock price that you're paying, and things can be either high or low in terms of that price for the expected earnings. You have what are called valuations, and a lot of times that can be captured by what's called a price to earnings ratio, but it maybe isn't just the PE ratio. There's different ways to cut it up. But the point being is that certain valuations, certain asset classes can just start to they kind of look expensive. Like you're paying quite a bit of money for that future earnings. So Jonathan, maybe just to kick it back over to you, is that part of like, is it some of these indicators are suggesting that, hey, look, this current asset class has got, a high valuation. It seems to be getting kind of expensive. Maybe we need to be pulling back in terms of how much we hold to this, allocation, because if anything, this is maybe just a good price to getting out of our position, and we'll either get out of that position altogether. We don't even hold the asset class any longer, and we're just all to cash, or we'll at least be trimming back our position there, and we don't just hold a flat percentage. Like we're closely following these valuations to make decisions about how much to hold. And does that seem reflective? That's at least my understanding of what would take place. Is that fairly, broadly speaking, accurate in your own situation?
Yeah, I'd say you're dead on as far as the strategies. Our more core strategies, they'll go long or to cash, or in rare cases, 2 times long the market if indicators are really strong in one direction. Our more aggressive strategies will be long short, so we'll even go inverse the market in cases of downturns based on market indicators. Each strategy is going to be focused on a different segment of the market. So there's a lot of room for diversifying across historically performing strategies to create a well-diversified portfolio that can see a good risk-adjusted return as well.
Right. And again, the point here with Jonathan on a risk-adjusted return, just in case folks might not be familiar with that language, what we're really trying to get at is that, like, if we could cut out some of the volatility of a portfolio, even if it might necessarily mean less return, but it's not as bumpy of one. Like, so let's say we have like a 10% returning portfolio and it's really bumpy, but another one that's like a 9.5% portfolio that's not nearly as bumpy. Like, okay, perhaps maybe you give up a little return for getting that 9.5%, but it's a lot smoother or easier of a ride. Like risk-adjusted portfolio, that the intent here is not so much necessarily outperformance or better returns. It's smoother rides and, getting as much return for the smoothness, if you will, that's allowed.
I'd say we definitely do that. And if we can, do better than the market, great. If we're looking at a beta of 0.64 and still beating the market, really where we win big is when our indicators go to cash, and then we get back in the market when the indicators point back forward. If we can be in cash and not lose that 50%, have to gain 100% back, we really look at max drawdown on strategies as far as how much an individual has historically lost compared to the index for the strategy. I I think that's a great selling point, especially when we had a lot of people in '08 lose 50% of their portfolio value and had to wait to retire, had to wait for that to come back.
Yeah, well, and so some of this, folks, I mean, because I've seen this firsthand with clients, perhaps maybe more like with company stock, let's say, but let's say we have like a client account at 100,000, and then the company stock just explodes, like it's all, and their account value goes up to, I don't know, 250,000. It's like, oh my gosh, we've made so much money. This is great and wonderful. And, so that maybe transpires in the course of 12 months. And then 12 months later, the account balance goes back down and you're down to like 120,000. And like between point A and C, like you're actually up ahead,
You still made some money. It just looks like, it feels like it's the end of the world.
Yeah.
It's surely not.
Yeah. I mean, but what happened between A and C is like, at one point I was up to 250,000. You kind of got attached to that. And you were now thinking of all these great things you're going to do with all this money and how rich am I? And I was a genius. But now it's back down to 120. And the truth is you're still, ahead, but you just don't feel ahead because, historically you were previously at 250. And so, this whole notion of volatility is an important one. On a one way, rationally, it's like, oh, well, it doesn't matter because, like, look, I'm still out ahead. What's the big deal? I'm above, in my scenario here, I'm at 120, and when I started with 100, like, this isn't such a bad deal. But like, we don't respond to it that way. Like emotionally, like this is like, oh my gosh, I've lost all this money. And, well, you did, and you didn't, right?
I'd say, yeah. For an individual looking at how their portfolio is performing, I mean, really part of our risk tolerance questionnaire is really looking at what is your expected rate of return? Do you want 8 to 10%? Are you looking for an 8 to 10% return, over 10%? Really look at time-weighted return in your investments to see how you've done year over year since inception. That speaks volumes to how you're investing, what you've really seen, because you could have a bad year and still have a great time-weighted return. If you have a 10-year-old account, time-weighted return is going to be the most accurate to factor in your distributions, contributions, advisor fees, and really see what you're getting for what you're paying for. Yeah.
Right. And just to speak a little bit to a time-weighted return, in case you're not familiar with that, anyone who's listening, is that, there's different ways to turn around and measure performance and how things have gone. And you could have just like a simple return of maybe, again, like we started with 100,000 in the account and now it's up to 200,000. It's like, well, we've got 100% return, but, how much that return means, well, it's like, well, how long did it take you to get there? I mean, it's great if that happened in a couple of years' time. If it took 50 years to go from 100,000 to 200,000, then we have two different sort of scenarios that are happening. So, a more refined notion of return starts to factor in, the passing of time as to, what's transpired. That's usually referred to as an internal rate of return, but like a time-weighted return goes even further and starts to adjust things based off of the dates that contributions were made and the date distributions were made. Because like one of the most challenging things in assessing returns in any portfolio is that as, you make contributions, your portfolio will naturally grow. And so it's kind of hard to know, like, well, how much is my portfolio growing? Because to some extent it's growing because you're making contributions from it. Or vice versa, if you're pulling money from it, your portfolio maybe naturally will go down, but it's like you're pulling distributions. So like a time-weighted return, to kind of expand upon that, is a way in which we start to factor the return based on the date of contribution and how much was distributed. And I don't know the fine-tuning of how they run the math behind that, but it's probably the most elaborate or detailed of a return calculation. Is that your take or your experience on that as well, Jonathan?
Absolutely. I mean, having the time frames for when contributions were made and see how much you returned based on those time frames, like the actual contribution dates. I mean, a client puts in $100,000 into an account and then $50,000 later that year, they want to see a time-weighted return because that's going to factor in the first half of the year returns compared to the second half, and then put those together. I'm not sure on the fine-tuning. I know it's the most accurate return you can provide to a client.
Right. And then just kind of to share more on that, folks. I mean, it's just like maybe you start with 50,000, but then you make contribute of 100,000. And it's like, did you make that maybe contribution right after you made the other 50, or did it come maybe 2 years after the other 150? Again, a time weighted return will start to figure out just how well you've done. And, the account balance conceivably could come out to the same if we had like a side by side scenario. But once you start to analyze the time weighting, the return calculation between these two could very well be different. And, which rate of performance, measurement of performance should we be basing things on? And so, Jonathan, I agree. I mean, I think a time weighted return really is the best and most true way to assess and weight a calculation. Although maybe the last comment to make on that, folks, is that there is some sensitivity towards the length of time in which you're working with. And so if you're working with a relatively small sample size, just like you have in statistics, the final return calculation can go really high or low. And so, where time weighted return really starts to hone in, give us a great number, is when we do have like a good expansive time in which the whole thing's being done.
Several years. I mean, most of the clients I'm working with have like 10 years of that I can show them their time weighted return. You can't look at it in isolation with just a couple of years. But,
it's just it starts to be hard to screen the signal from the noise, as they say in that situation. Like maybe things have gone well, maybe they haven't. You just haven't tested it long enough to really know whether or not it's been worthwhile. So going back to the tactical asset allocation, you did throw a few terms out around too, Jonathan. I think maybe the audience just isn't as familiar with this notion of long or short or double long or long and short strategy. Do you mind maybe just sharing a little bit of what that entails or that means?
So we get the market data from third-party companies. We then get signals from the company whether to buy or sell in a security or go to cash. We use leveraged securities in some of our aggressive strategies, or most of our aggressive strategies, to go either 2 times long the market or leveraged long the market 2 times, long to cash, short, or even inverse leveraged the market. So we can use contracts to essentially buy contracts that allow us to do that in our strategies. Some of our strategies will utilize margin for trading, but for the most part, we're not trading same day on a lot of these. But we'll collect signals anywhere from like a week on some strategies to every day on others, with different methodologies on all these strategies, but all historically doing pretty well. Yeah.
So, I mean, just to confirm, even from my own understanding, because tactical asset allocation admittedly isn't something that we employ very much in our own practice. So, if you're going 2 times long the market, what you're meaning by that is we're buying the securities at their current price, but maybe we're also utilizing underlying derivatives or options to double down on that purchase. Or what do you mean by 2 times long?
we trade in ETFs on these strategies. So for the most part, they're ETF traded strategies. So maybe like the Ridex 2 times, like going double long the S&P. But there's existing ETFs that can also provide that leverage in most of our strategies as well. But options contracts, I think it's options contracts, allowing us to go 2 times would be the mutual fund alternative, unless the mutual fund is set up to be leveraged.
I see. So, and maybe just the takeaway, folks, for to expand upon this is it's like kind of intensifying the bet that we're making. But if like we're particularly optimistic about the future and we really want to buy in a lot into the market, we're doubling down, so to say, on that optimism through the fund, which some of this, when we speak of leverage, I mean, if we're particularly optimistic, it's almost like taking a loan out against something else to add, so we can throw even more capital, at the bet, so we can increase, the payoff. But then, to go short, that terminology would be kind of implying the other way, where our bet isn't. It's kind of then suggesting a degree of pessimism, either not about the market necessarily as a whole, but perhaps against this industry or that sector or that type of stock, in which we're making a bet against that. And so all these techniques are ways to amplify the bets that are being made. We're not just making maybe a single bet, but we're making perhaps multiple bets in a series together. Do you feel like that's kind of a correct assessment?
Yeah, I'd say that's a correct assessment. And in those long short strategies, that's where like the downside and upside capture really come into play. And when you see like well over 100% upside capture, it's because we're going twice as long the market.
Got it.
Okay.
So, and then, the benefits to this is these additional gambles is we'll either see higher returns or we're pulling, in and out of the market, the moving all to cash. Again, a buy and hold strategy wouldn't be employing this sort of approach. And so, if we could be looking to see, maybe now is a good time, or value, as I was alluding to earlier, valuations are just too high. Things are overpriced. It's not a good time to be buying. If anything, it's a good time to be selling. Those would be some of the indicators that we're looking for to make a decision to say, hey, we're anticipating that the market isn't going to sustain at this price point, valuation point as it is. And so it's going to contract, it's going to retreat. And rather than ride through that drawdown, we'll just simply, take our exit now, wait for the drawdown to take place, and then make a decision to come back in. Yeah, out of curiosity, as we kind of wrap up some of this question on tactical asset allocation, again, I know that you're maybe not at liberty to go into any detail on some of this, but what would be some of the signals or ideas that you're looking towards to cue someone to get back into the market?
As we have moving stop losses that are calculated based on market indicators for getting out of the market, the same to get back into the market. So if you have a big enough drop where we're back to cash, and then we have a large enough gain based on third-party market data to justify getting back into the market, that's when we make moves. So it's not necessarily a short day-by-day play on the market. We're not day trading. We're analyzing overall trends in the market, focusing, every strategy is going to be different market data that's collected. We even have one strategy that will accumulate several people's data, and then they'll get together and make a decision on what to do that day. And then they get weighted based on how often they're right, how often they're wrong, and on how many points they get. And we have just such a vast variety of strategies that it's hard to give an exact answer to that. But I think I did okay.
I think so too, Jonathan. So yeah, there's, again, maybe as a kind of a final takeaway with that, folks, is that there's, leading indicators, there's current indicators, and then lagging indicators as often as it's described or, categorized. And so it's utilizing those indicators that would be giving, early clues, if you will, suggesting that maybe a action is needed before it becomes too paramount or obvious. And, you could, choose to take the information from these indicators and make a decision. And, the final outcome from this isn't necessarily that we outperform and do better than everybody else. Obviously anybody who's managing money is wanting to outperform, at least in some capacity, but it's more of a statement of, can we just minimize or take away some of the volatility that's that would be taking place? And going back to the company stock, what I was making mention ago, a moment ago, of maybe you have 100,000 and it goes up to 250, and then it comes back down, it's down at 120. If we can just not take that peaking and write that out of the story, where okay, we just went from 100 to 120, we didn't have to necessarily write through it all. Or better yet, maybe, when it did peak, we knew it well enough to sell when it was peaking and then move back into something else. These are the sort of things of this is, this would be that timing that we would want to be optimizing and maximizing and really, quite frankly, capitalizing upon. So that's again, thanks so much for sharing your thoughts on tactical asset allocation. And it's not a topic that we've chatted much on, but that wasn't the full scope of some of what we wanted to have conversation wise. I know that you had received quite a bit of mentorship, Jonathan, too, in your time at Fidelity and Equitable, and there's been a few takeaways that you've had that were some quotes that you've just found to be really meaningful, from some of that mentorship, but just in life as you've been working in this financial space. I was hoping maybe you could help just leave the audience with a few tidbits of wisdom that you'd like to share. What's one that comes to mind that we were discussing ahead of the call?
Yeah, of course. So Steve Seibold. He has a quote that you're either growing or dying. Stagnation does not exist in the universe. And I like to apply this to kind of the big three aspects of life. So my spirituality is what I'm doing, helping me grow closer to God or turning me away from him, and kind of analyzing my decisions based on that. For my family, are my actions causing the love in my family to grow? Are we growing closer to God together? Or is that love diminishing? And then work. Is my practice growing towards achieving my goals or shrinking to something that needs to be corrected, due to something that needs to be corrected? Am I putting forth the effort, staying on as on course as I can, and keeping the end in mind?
Well, just to elaborate on a few of those. I mean, so I think a lot of what you're conveying, and it does have its connection to some of our prior conversation, is just the importance of living with intentionality, in the day to day, and to maybe not take things for granted, and to be, as the expression is, carpe diem, to seize the day, each day, and make the most of each day that comes to us, right? Because none of us knows when it's going to be our last day, and we're all left to be surprised as to when that might be. And my family and I are fairly involved within our local church and community and parish, and it has it's mostly good with it. Sometimes it has bad, if I'm being honest, but it's mostly good. But one of the things that we see in that is a kind of a regular reminder for us is just people come and go. Either families come and go because job changes move them in and out, or people just simply pass away too, and sometimes in rather tragic and unexpected ways. And it brings kind of conversation in our own lives, my wife and I, to not take the day for granted, to appreciate what we have, and not to spend our entire lives maybe wanting for more when we were kind of looking past or ignoring what was before us. And so, Jonathan, I'd like to get you to share some more thoughts on that. Before I do, folks, I mean, if you're looking for maybe a financial advisor who gets that, who understands the importance of not just living in the here and now, but looking with an eye towards eternity, be sure to take a look at the Catholic Financial Planners Network, and look at some of the advisors. Maybe you can find somebody in your local area or in a particular specialty that you're looking and needing. But we're growing day by day. The network is, with new advisors, and many of the advisors, I dare say all of them, have this as a committed framework and goal and mindset of their mind. So be sure to check the Catholic Financial Planners Network out. But Jonathan, what are some of your thoughts here on this notion of just living with an intentionality and the importance of doing that, for your family life, for your spiritual life, maybe for your finances?
When I came to this company, I remember third or fourth day, I reached down in my desk, which is my predecessor's desk, who was assisting Dina, the president and my mentor. I found a prayer card from her husband, who has the office across the hall from her. I sit right outside his office, for his father. And I gave it to him, and I was like, hey, I found this in my desk. It was a Catholic prayer card. I was like, strange that this is sitting in someone else's desk prior to me. But I went back. I then departed from him, came back maybe 3 months later, and we're having a conversation. And he pulls up the first dollar bill that he ever made at Global View Capital Management. It's laminated. And he told me, like, it's important to keep this. He still had the prayer card on top of this, so on top of the dollar. And I was like, wow. Yeah, to have someone who is that successful have that mentality. That the people I'm working with, I'd say, I like how they're supportive of who I am and allowing me to kind of bring that to work, which is my intention and what I'd like to do going forward, and what I have done since I gotten here. I don't want to build just a Catholic book of business, but that's primarily who I work with on my side of the business.
Sure.
And my book of business. But just keeping God in the front of my mind all the time is kind of what I try to strive for. And daily rosary too, if I can, but that's, 2 kids, it's not easy to do that every day.
We all have to make adjustments and work these things in as we're able. Isn't that the truth of it, right?
But yeah, I mean, just being aware of what I'm doing and getting a little better each day, as my wife says.
Absolutely. Well, Jonathan, it's been really good to have you on the show and for you to share just some of your philosophy on life, the take on, again, tactical asset management that's offered through and with your firm. Folks, again, if you'd like to connect with Jonathan with Global View Capital Management, where can they come and find you, Jonathan?
Yeah, I can either be emailed at Riesch at gvcaponline.com, or you can call me directly at 262-650-1030, extension 117. If I don't answer, just leave me a voice message and I'll get back to you next day or same day in a lot of cases.
Yeah, so folks, I hope you do get a chance to reach out and connect with Jonathan, explore maybe more of this tactical asset management approach. It is, it's still investing, but it's it's not really active investing, but it's taking things up a notch beyond just a simple buy and hold strategy that you might more commonly see put into play. And the intent there is, again, to improve the overall return once you factor in for the volatility that, that would be at play otherwise. And then, Jonathan, just, the story and the focus of intentionality and living with purpose and not taking things for granted. And then maybe most of all, not losing track of your priorities and, knowing what is important in life. I mean, finances have an important role to play, right? For all of us, but it's easy for us to turn them, into a God and to have it be, the sole idol of what we make our lives about. And, what I appreciate about this conversation today is just this reminder of it, like it's, money is only so satisfying. It's only so fulfilling. And there's, other ways to be winning and achieving as well. And, let's keep our focus on winning and achieving those ways too. Money is not the only standard to live by. So do you have any additional parting thoughts of wisdom you'd like to give to our audience?
So I've got a buddy who told me, like, the thing about money is it's never enough, kind of what you just said. Like, there's always something more you'd want to do if you had the money. But I think the most important thing is to reduce those financial worries. Have a solid plan in place no matter who you're working with. Make sure you have the correct products to accomplish your financial goals. And sure, money makes life easier, which is great, but God's grace is always enough, where money can get to the point where it's never enough. So,
absolutely, I couldn't have said it any better myself, folks. So, I mean, those are definitely pearls of wisdom. So, folks, be sure to check out the Catholic Financial Planners Network. Take a look at our advisors. Be sure to look up Jonathan Riesch with Global View Capital Management and give him a call as it suits your needs and your interests. But Jonathan, thanks so much for being on the show and sharing, some of your background and your thoughts today. It's been a real pleasure to have you.
Thank you so much, and reach out anytime you want to chat.